The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Good afternoon for most of you, depending on what time zone you're on. My name is Brittany Melville with Next Generation, and we're excited to be introducing our guest speaker for today, Kaylee McMahon, who is founder of the Apartment Queen. And for all of you who registered, you know that today we're going to be talking about multifamily real estate investments and using self-directed IRAs as an option for these types of investments. So Kaylee, with her expertise, is going to talk a bit about the multifamily side, how to vet some different deals and some examples. And then when she's finished, I'll talk about the self-directed IRA side of things and how that can be used to apply to these types of investments. So just a couple quick notes. We are recording the webinar, so if you weren't able to join live, but you did register, you will receive a copy of the recording following the session. This should be about an hour long. We're going to save some time at the end for questions. But if you have questions, feel free to enter them into the chat or question box on your GoToWebinar panel as they come up. And we will try to field them throughout the course of the session as we can. So with that, I will let Kaylee take us into the multifamily discussion.
Hey everybody, thank you so much for joining today and taking time out of your what probably is your lunch to join us, whether you're in Texas or if you're in Arizona or New Jersey or wherever you're at. This is what's so cool about the whole online thing that we have access to now. And I wish I could share my face, but I can't get my webcam to work. So, you know, another time we'll definitely have to fix my settings. But for now, we can just show you this presentation, and I'm really excited to because I've done this before, and it was, you know, before it was BC, you know, before Corona, and so I did it in person, and everybody really loved it because really, like, our company is all about transparency. Me as a person, I'm all about radical transparency. So everything that I, you know, put out there or do is about being transparent. So this is kind of talking from a passive investor's perspective, trying to be in your shoes and say, okay, if I was in your shoes, what would I want to know about my prospective investments? I'd want to know, you know, how to do my due diligence on the people, the project, the numbers, all that stuff. So we won't go completely into the weeds on the numbers today, but this is just a good, I think, 30,000-ish foot view of what I've seen out there and what we've done to be able to give success to our investors and partners. So that's me, Kaylee, with the Apartment Queen. Changing the face of multifamily is definitely at the core of everything we do. We look at having more females being leaders in multifamily real estate because there are not enough currently. So kind of already did the introduction slide, so I'll see if I can skip over that one. So there, ta-da! We'll go ahead and get started. Okie dokie. So it's really important for you as an investor to understand what your target market is and to know why you have that target market. So for us, for example, Dallas, Fort Worth, Houston, Austin, San Antonio, and Phoenix are our target markets. And that's just because of certain metrics that we have, and I'll kind of go over those in some slides moving forward. But at a really basic level, you're like, why would I invest in a certain place? We ask, is it landlord friendly? Is it tax friendly? Is it business friendly? And then also the criteria of knowing, you know, what you want for the deal. So for example, certain markets are more expensive with insurance, you know, like for example, a deal we did in Houston, the insurance is probably almost 3 times as much as it is for our Dallas or Austin deals. There's just certain things that you kind of need to know that are unique to every market, and kind of decide ahead of time before you're even looking at people's, we call them a PPM, private placement memorandum, or their deals, kind of know what your target market would be so that it makes it less confusing whenever you're looking at somebody's documents or their deals. So, so that's important to know in the beginning. I'm trying to, there we go. Something else that's really important to know. So whenever we are doing a presentation, we usually do a slide deck, or I mean, honestly, every syndicator slash principal or anyone that is putting together a group of investors to take down a large apartment deal, they will have a presentation for the investors to look at, kind of like this, but it's asset specific. So I put together a list of questions, and I'm not going to go through all of these, but basically if you want the slides after this, you'll be able to see all these. But these are questions that I make sure that we answer in that slide deck as much as possible. And the questions out of these that are not answered, I really encourage people that are looking to passively invest or be limited partners in these deals, such as IRA account holders or retirement account holders, are just because, again, it helps you do your due diligence on the sponsorship team. So some of the most important information that I want to make sure that I know and be super realistic about it, because you want to know the worst case scenario on everything. Like, what is the hold time? If you're someone that's looking to get in and out of a deal that's 3 months long, 6 months long, multifamily is not a great place to invest, and you have to have realistic expectations. So for example, currently the way we do it is we do 3 to 5 years is what we project as the exit. And again, that's super variable depending on what's going on with the market. Our track record had been 12 to 24 months, but again, as you see with like coronavirus and or the effects of this may turn into a financial crisis, we're not sure. So that's why we always under promise and over deliver. So again, you just want to know worst case, what's your hold time? That's really important to know. And then one of the, I don't know where it is in here, but one of the ones I get asked all the time is when can we expect our first payment or check, and how often are we going to be receiving those? And so every different sponsor or principal that's doing these deals, they'll have different answers to that question. Some will say 6 months that you start getting your cash on cash return. Some will say 12 months. Some will say 15. It's very variable depending on the type of project. So we look for very heavy value add properties, which means that we're going to have to spend, for us, at least 12 months making sure we do all of the, switching out of the non-paying bad tenants to good ones, doing all the renovations, essentially stabilizing the property. So just being really realistic about what your returns, what your expectations are for, a timeline on that. And then again, there's a bazillion questions I asked here, when will I get my K1, things like that. So again, I forgot to mention, but if you guys have any questions along the way, feel free to stick that in the chat, and that way when we get to the end and we have our time to do Q&A, that you won't forget, some important questions that you want to ask. So let's go to the next one. So again, like I mentioned, deal criteria. So knowing your deal criteria, it's very important because it also is correlated to your return expectations. So this is our example deal criteria, and actually, it's changing. This is, again, BC, before Corona, so things are changing a little bit. But prior to everything happening, we wanted Phoenix and Texas, again, because these are landlord-friendly, tax-friendly, business-friendly states. There are other ones like Florida, parts of Georgia, and there's a few other states that are that meet that criteria. But with these certain states, we just feel very confident that we can operate a business how we need to make the profit that our investors expect. For us, 1970 or newer, this is about the very end of a C-class vintage right now. So C-class basically right now meaning up to 40 years ago, but then it also is dependent on how much deferred maintenance there is. So meaning like how bad the current owner let the exterior get. Did they keep up the property, or is there a bunch of stuff we have to fix? So we feel comfortable with doing C-class and B- class properties. There are other groups that do B-class, other groups that do A-class, which again, there's different return expectations on your timeline, and then also return amounts. The class that you get higher, A-class, B-class, things like that, you're going to expect less risk but way lower return. So we find that a C-class is a kind of happy medium, and we don't do D-class. That's super high risk, but super high return. So again, you just kind of have to know your risk tolerance as an investor, and knowing your criteria again helps, or knowing your risk tolerance helps you with your criteria. For us, like I said, it's a heavy value add. So being 10 to 15% below market rent on every floor plan. When you're looking at somebody's somebody's prospectus, you're going to be looking at what they're expecting to bump their rents up to, and so knowing what the market rents are. So for example, if you're really comfortable with Phoenix, or you're really comfortable with Jacksonville, Florida, or wherever, and you know what the market rent is there because you've done your research, you would be able to look at this prospectus or this PPM and the documentation and go, okay, they're projecting that, year one, I've talked to people that are like, year one, we're going to bump up the rents, like $100. And I'm like, no way, that's impossible. The whole entire complex will vacate and the project will fail. You want to keep it cash flowing. Anyway, and just there's different types of deals. So for us, finding that we have that much room below market rent means that we can increase the market rent, still stay below market to keep it competitive, but be able to make quite a bit of income. And then if you have floor plans for us that you can't bump the rent on, we just don't even want to deal with it, because if we can't, again, as a business owner, across the board be able to bump the rents, that's where we extrapolate the value add portion of it. You have to be able to bump the rents and do the renovations to increase the value. So like I mentioned, if you're doing B class or A class, it's not going to be a heavy value add. Like B class, we do have one that we did there where there is a value add. We did, bathrooms and kitchens, but otherwise everything else was great. We added a few amenities. A class, you really don't have to do anything. So some of this criteria will not fit if you're wanting to invest in a different type of asset class or type of class. And then for us, we look at 60 plus units. One reason why we picked that is because if they're doing a plan where they're saying, okay, we're going to do heavy construction, renovation, there's already people living in the building, it's really important to know about their plans for property management and for property maintenance. So whenever you're above 60, and now it's more towards 70 based on pricing and things, at that point, at that price break, I guess, with the income it will bring in, it starts making more sense to be able to have a third party property manager and maintenance person full time. So if you're hitting any units below that, a lot of my friends, will ask me to do 24 units, 38 units. And I mean, I've done it before, but it is so labor intensive. And unless it's literally right next door to my house, I don't feel that we could manage the project efficiently. And again, having a third party management company, they're experts at what they do. I'm not. I know the majority of what we need to see in those reports and how things need to be performing, so we know we're tracking along with our goals. And kind of sometimes, what to switch, but as far as doing it day to day, having somebody on site and having someone to manage, like we just had a fire actually this weekend at a property that we have in Denton, Texas. And because the property staff, it was a Saturday or whatnot, but they have a local person immediately contacts, the fire department, the police, everybody, and gets them on site immediately, pulling people out of units. You have to have, I would not self-manage again unless it was really literally next door to my house. And again, self-management, sometimes you just want to let the professionals do their job. So we find that above 60 units, we're able to achieve that and have it be reasonable for our operating budget. So this is an example business model for multifamily property investing. And so this is kind of a stepwise process. So for example, if you're looking at a team and you're kind of trying to figure out, do I want to partner with them? Do I want to be in their deal? You'll hear it. For us, multifamily is a very small world. You could literally go ask other people that have already done deals with these people, and if they've done a bad job, you'll know. And if they're doing a good job, again, you'll know. But if you're maybe not local to that market, and again, right now we can't network in person, and so it's kind of difficult to do this. For me, looking at a team that is built out is really key. So for example, we use a CRM, and that CRM is a way that we manage all of our different things. We manage our incoming apartment leads, so deals with brokers. We manage our investors, so as far as funds, communication, things like that with them. So we have separate different CRMs to manage this. So it's anyway, but just to manage where everything's going. So it's structured with the long term in mind. Somebody who, don't get me wrong, when I started, I had spreadsheets. I had Excel spreadsheets, and then Google Sheets that we would share together and things like that. But if you're looking for a team that's a little bit more established, knowing that they have systems in place is really important. Let's see, and then again, so this is things that we do that I feel like have worked really well in the past. So obviously we're keeping all of our investors and our leads and our funds all organized. And then the next thing that we do is make sure that we have a team that's analyzing the potential market with our real focus data, which I'll go over in a minute, exactly what that means. But so we have a team where all of us know how to utilize this type of analysis. And again, we have a specific person that handles underwriting. Again, when I was in the beginning, just like any other business owner, you're wearing multiple hats, you're doing quite a bit, so in the very beginning, it's hard to juggle everything. But when you're looking for, again, a company that's done several deals, that has to manage, like I think right now we're managing seven different deals, currently looking at probably 3 to 5 new ones a week. They have to have a system again. So systems being in place is really important, I think, to see, are these people going to be around for a long time? So I wouldn't want to put my money with someone that just wants to do a one-off deal, two-off deal, something like that. I want to go with professionals that this is their full-time job and they are 100% invested in it. So then once we have that system of going through analyzing the deals, then there's a process where we have a letter of intent, and then we work with attorneys. That's another thing that's really important. So like step 4, EMD is earnest money deposit. So once we have submitted a letter of intent and it's been accepted, then we move into engaging our securities and exchange attorney. So I'm not an attorney, I can't give advice, et cetera, but basically, again, knowing that they have a built-out team with a professional that is handling the exchange of securities. They handle the formation of the businesses, the LLCs. There's one for the manager, there's one for each different property. It's all separate. Again, just knowing that these people are involved to help reduce any kind of liability and to be able to protect your investment. So seeing a team, again, is important.
Hey, Kaylee, sorry about that. Just a quick question that popped up in the chat box. Someone was asking about what CRM. I guess maybe they're asking what does it stand for?
Oh, customer relationship management. So it's just a general term for, again, a way that, like, you could literally have a quote CRM, in a spreadsheet. You could put down people's names and email addresses and, tag yourself in a follow-up in your calendar. But we went ahead and utilized a system. We use Podio. There are people that use Infusionsoft. There are people that use Salesforce, all kinds of different customer management systems. But again, we use ours to track deals. So we have one separate for that, another one separate for our investor relations for our investors, and then another separate one for money and funds, and making sure that all that's all being followed up with. So customer relationship management. Does that answer it?
Yep, thank you.
Yeah, of course. And so again, we syndicate funds. You want to see the attorney being involved. So we syndicate. People kind of get confused when they're looking at things as far as like JV or joint ventures versus doing a syndication versus doing a TIC, which is a tenants in common. So when you're getting involved with limited partners, I don't know how to say this, the investors that are doing retirement account investing, those are going to be limited partners. So it's really important, if you're a limited partner, to make sure that you're like limited, meaning you're not actively doing anything, you're just putting the funds into it and getting a return. It's really important to know that what's happening there is that you're exchanging funds for a position in that property. Again, I'm not an attorney, but you either have shares or you have a position or you're a percent owner or whatever. All that means is that, the amount of equity that you own in that deal is essentially, it's a security. So again, there are deals that I've done that are smaller that it wasn't 100% necessary to do, a syndication or to contact an SEC attorney, but I just wanted to play on the safe side. So I went ahead and paid the money and went ahead and did it, the kind of formal way. A lot of people I see out there that are doing joint ventures, I'm kind of like face palming myself, because I'm like, you are selling a security. Like, you are giving an investor who is not actively involved a position in the interest of that property, so physical property and interest in it, therefore that's a security. So again, I just played on the safe side and made sure we had a professional handle that. There's just things that I've seen where, and you could do, like I'm saying, a joint venture, which in a position where you do have limited partners and an active partner, and there's just a large limited partner, so meaning they put in the majority of funds, but they're not the one there on site day-to-day doing stuff. That's a TIC, or tenants in common, where you partner 2 different entities, and one can stay passive or both can be active or whatnot. But just it's registered with the SEC, or Securities and Exchange Commission, so it's like 100% legal. So again, I'm not an attorney, but I just like to be legal. So, having some structure is good for me. Let's see. And then again, once we have the attorney involved, then we go immediately into doing our due diligence. So I think I skipped over that for this, but basically the due diligence period is when the team is going to reach out to their current investor database and say, hey guys, we have a deal or an upcoming deal in Jacksonville, Florida. Would you be interested? Email us back. And so then as we go through, so then we will qualify those investors and get them ready. If the deal then passes all of our assumption criteria, which means that we could produce the returns that we project, then we will stay under contract. We won't walk away from the deal. And then at that point, then we can start collecting funds after due diligence is finished. And it's similar with everybody else. I don't know. There may be people that don't do it this structured, and they may take funds immediately once they just say they have a deal or whatever. We legally can't do that. We have to have the documentation showing the projected plan, who's involved, how they get paid. It's called the PPM, or private placement memorandum. And once everybody has read and accepted, and also you're going to be looking at the OA, or the operating agreement, that actually is very key to see who does what, how the voting works, all that stuff. But not until the investor has reviewed all of that documentation would it make sense to move money, right? And so just being set up with the SEC with an offering like we do, it guarantees that the investor is not giving money to anything, to just like a random thing. It's actually like you can make sure that you're putting it into an investment. So, and then at that point, the trust company, like Next Generation, they would get involved. They would see our operating documents and all of the documentation that the investor has already read and has already agreed to, and then they can move forward with the transaction on the investment account side. So I'm kind of going to skip over this because this basically just goes through kind of after we close what we do. For us, we do 12 months of value add, but I think I mentioned that earlier. Every team is different the way they do it. We just don't do it until we know the property is locked down, secured, like we've already changed out the tenant mix, we've already done all the renovations, we know that it's going to be stable. And so therefore, when we start paying out dividends, it's not paying it out of a small account at that point. It's paying it out of a large account that's been built up over the last 12 months. Plus, we have now, with what our goal is to double the value that we buy it at. So now we're sure that with our exit price, we can achieve that based on all the renovations that we've already done. Sometimes, like right now with the virus and all this stuff happens, and you lose a contractor, someone gets sick. I've had people's mothers die. I mean, all kinds of just stuff happens, right? And so giving us that 12-month window to get it all done, make sure that when stuff happens, we can come up with plan B, C, and still be able to get it done. So we give ourselves enough time. And again, we start quarterly distribution.
Question that popped up. I just wanted to address before we move forward. Someone asked how many investors in a deal is ideal?
That is a funny question because it totally depends on the type of deal. Ideal used to mean one thing to me, and now it means another. So it really depends on, so if we're speaking in the sense of a limited partner, I mean, honestly, we could have unlimited, and I don't care. It doesn't matter to me because, again, since we have those systems put in place, whenever everybody's getting that initial email, it's going out into everybody at once. When they reply back that they would like to see the deal offering when it's available, they're getting a questionnaire. The questionnaire goes into our system, and the system has everybody kind of put into a line in our internal portal. That's what I call it, the portal. And then once we are sure that everything's going to work, then we can put our documents into that portal, and then everyone that's in the portal will just get notified, hey, your documents are ready, go sign. So most of this stuff, we're setting it up to where it's kind of automated, so we don't need to go back and forth and back and forth. If an investor has a question, typically the people that have questions are going to be on our deals that we don't do. So right now we do Regulation D 506B or buddy offerings, or we do Regulation D 506C, which I call it commercial because you can advertise, you can do commercials. The C offering, though, you can only take accredited, and the B offering you can take accredited and sophisticated. Typically, the only time we see people like having to have a phone call is when, you know, they haven't done a deal with us before, which is no big deal. It's just 15 minutes. I don't mind. Or any of us on the management team, we don't mind. And then we're limited to 35 unaccredited, aka sophisticated individuals on a B offering. So I mean, that's 35 phone calls max, and we usually never even get that many. I might have 10, you know. So I really don't mind, you know, as many as it takes to get the deal done. Yeah. Let's see. And then again, yeah, and this is an example deal that we did in the past. This is Houston, Texas. Yeah, so I want to show everybody like an example of like the worst deal we've ever done, because normally, again, we look for value add deals. This is a yield play deal. So meaning there's not as much physical change that we can make, therefore sucking all of the value out of the property because of all of the improvements we've made. This is more of an operational play. So you'll find inconsistencies like, you know, certain fees aren't high enough, certain fees are not being collected, they have bad debt, they don't have all the units leased up, just things operationally as a business that we can go in and fix and be able to create a return, which, I mean, just for doing that, you know, 86% return is not bad. Typically, we're targeting about 100% on 5-year. That's why I said this is the worst we've ever done. But again, this one there's no heavy construction, which is usually like the most difficult process about all this. If y'all have ever flipped a home, I have. If y'all have ever dealt with, you know, it was a meth house that I bought, and it was just like, oh yeah, I'm young and I've got energy, I'll just do the hardest thing ever. That can burn you out over time. So having an 86 or 87% return for just doing a few operational changes is not bad. So we will do these time to time, but the value adds where it's at. Next one. Okay, so when I mentioned earlier our metrics going through, we're just going to go through what we use for our market data. So there are 5 metrics that we use to look at. We call it the real focus data. And this is when we're looking at a prospective market. So this, I think, helps passive investors or limited partners, if you will, to look at a prospective market and go, is this a good fit for me? I can never say guarantee, but is this going to give me the best odds possible to give me the best returns that, you know, we're projecting? And this is kind of what we go by. So if we're looking at a city, we look for population growth. That's the first thing we look at. And this kind of goes through exactly, you know, if it's between 250,000, 1 million, et cetera, you want 20% population growth. So we get all of this information from city-data.com. So I'll just quickly go over that. Number 1 is real focus data. Number 2, or not real focus, sorry, market. What did I say? It was, population growth. Yes, so number 1, population growth. It needs to fit those metrics. And hold on one second. My email is popping up. Number 2 that we hit is median household income. So that's the second thing that we want to make sure that we're making happen whenever we're looking at a prospective market. And the third thing is median house or condo value. So again, city-data.com, these 2 are real simple with the kind of metric you want to hit. And then also, so 30% median income growth, and then 40% median house or condo value growth. And this is a delta over 10 years or change over 10 years. So you're seeing, and again, beyond year 2016, add 2.5 growth. So these are just 3 metrics that we look at when we're looking at a prospective market out of 5 that we look at. And then 4 and 5 are changing crime levels. So again, it's from city-data.com. We look for crime to go down over basically the same 10-year period. And it applies to city of all sizes. You want to stay below 500 is the number, and 500, I believe, in the crime table means 500 murders per square mile per year, I believe is what that is. So when you see it higher than that, that's a kind of a warning sign, but then again, you want to see it decreasing over that 10-year period. So if it's increasing, we don't look at it. If it's staying completely stable, we don't look at it. And again, if it's decreasing below 500, yeah, we'll look at it. And number 5 is 12-month job growth. This is like population growth and job growth. Those are my number 1 and number 2 factors for a market. If you don't have the correct population and job growth, like what are the economic drivers to bring people into that city to rent? Like nothing. There's there's really no big major deal. When I look at a city and there's only one major factory, one major business, you know, you need to have at least 2, maybe 3 different large, because these are work for us, it's C-class workforce housing. So we want to make sure that there's a reason that people are coming to that city. And then again, once we find out that say 4 out of 5, or maybe sometimes 3 out of 5 of these, or 5 out of 5, sometimes we get lucky with, like, you know, Austin or San Antonio and other areas, that we'll go ahead and then we drill down to the neighborhood real focus. So we go then by zip code and subdivision. So you go even deeper. And then when you're ever looking at a deal, like, I'm obviously super familiar with Texas, and I stay in my sandbox. I don't try to go too far outside of it because I know it so well. But if you're looking in San Antonio, for example, each different zip code, you have to drill down even further. You literally have to go like block to block because it changes so much. So it's really important to know as much as you can about that market. Now, for us, and really what I see out there, period, is that typically a 50K investment is typical for the minimums for capital requirements. I have seen a few deals that are like people that are really just like their first deal or they're starting, and they'll do 25K for an initial buy-in minimum. And then I've seen some deals that are 100K minimum because they're raising, you know, we did one deal recently that was $8.6 million for the raise, and the whole deal was 23.3 million. So, you know, again, because of not the number of investors, but because of the time that it takes to get more, we went ahead and made the minimum 100. So, and the use of these funds are going to be upfront. Well, actually, we put this in ourselves personally. We put in, and you want to see again on that Q&A slide for your team that you're vetting. Do they have skin in the game? That's another big question. Like, what percentage of the raise have you guys as a management team put in? We typically put in 10 to 16% of it, depending on a variety of factors. But we'll use that upfront to pay for the marketing and educational events that we have to do to put together investors, the earnest money deposit, feasibility and due diligence costs, legal fees, other soft costs, acquisition fees, travel, due diligence. All right, I said that, loan points. So, but then again, we'll keep 10 to 16% of that money in the deal, and then investors will bring in the remaining that we need. So this is my company. This is us. Myself, executive assistant, CFO, our property manager, our transaction back office coordinator, our senior underwriter, David. Cindy is our SEC attorney. Monica, she is working on learning how to go find deals. So she's kind of acquisitions. And then we're maybe bringing in another person to do acquisitions. Carolina is our core underwriter. David Gallardo is in charge of construction. We've got him, I don't know, in like 10,000 doors, and we're really trying to work with him to grow his team even bigger because he just does such good business. Gaurav is actually, we call him Gary. So he develops all of our back office CRM or customer relationship management systems, and then also connects those with different software that we use. Colby is our debt broker that we've used a couple of different times in the past. So he basically is one single person that has access to Fannie Mae, Freddie Mac, so agency debt, and also has access to regular bank loans and has access to private money. So whatever kind of package that we need to put together on a deal, we can use him to kind of source several different things to make up the sandwich, or what we call the capital stack for our deal. And then actually we just switched who we're using for marketing, but it was USource. Now it's BDEC Marketing, and she's doing a fantastic job. And then Asipa, he is the guy that, again, for me, I've learned through single family flipping and things that it's so important to do your due diligence on your partners, on anybody that is going to be working for us, because yeah, you just need to know. So, you know, he'll do a quick background check on you know, past, you know, crimes or felonies or bankruptcies, anything like that. It's very important to make sure. And I want that, you know, for us, I also want to be able to put him as part of our team and let everyone know that we do that on every prospective person that we work with, so that they know that we know what we're getting into. It's not a guessing game. We have a structure again for kind of how we bring people on. And that the biggest thing too is, if y'all did not know, if you're doing a Fannie Mae or Freddie Mac loan or agency debt on the deal, it may be a non-recourse loan, meaning if the project goes sour, it doesn't come back to the investors or the principals, as it won't hurt your credit, nothing will come back to haunt your current assets or take anything from you. But there is what we call bad boy carve-outs. So what that means is, if there's anybody on the management team or anybody involved in this deal that does something to be called a bad actor, so that means a felony or a bankruptcy, or there's several different things that qualify for it, the loan can then become due and payable at that point, and then can become recourse. So then they can go after your assets and they can go after individuals. So it's just very important for the team to be vetted. So anyway, I just wanted to, for us, we wanted to use that as a way to gain confidence when investors choose to work with us. So again, you just want to look for that structure. So a little bit about me and my why. So my personal freedom from abuse and codependency came from my investment activity in real estate. Being able to have cash flow gives you independence. It's awesome. Many women specifically struggle with the mindset shifts and education it takes to create their own independence and to become an investor. I have friends that are my age that I'm like, you can be an investor, and it just blows their mind. They're like, me? No way. I'm like, yes, absolutely, you can. But so for me, being able to use real estate to grow my generational wealth and be able to create cash flow, I've experienced this firsthand. And then also being able to teach individuals to understand risks versus rewards, and therefore being able to have control of their financial destiny, which ultimately, leads to independence. So I want everybody that is around me or surrounding me to be able to create the ultimate life that they want. And so it takes education, and it takes also going for it when it comes to investing. So for me, I just want to help everybody to get rid of end bondage and dependence on others, and to stimulate the economy. Now, I do depend on others for emotional support, friendships, for business relationships, but I don't mean on money, because unfortunately the way that our capitalistic society is set up, a lot of, and I'm doing a lot of research right now, a lot of the way the monetary system is set up is that there are a lot of people that don't eat. There's a lot of people that, based on the way that the made up dollar idea works, a lot of people have to depend on money to be able to eat or do basic things. And so anyway, there's more coming in the future, because we also are early adopters of technology. So we're looking at blockchain technology and a lot of other things coming. But we just want to create independence. So anything in alignment with that is great. So here's a couple of past projects that we've done. We've got 236 units in Phoenix. It's the flats at 2030, 48 units in South Dallas, the Meadows, 50 units in Colorado City, Texas, and then 133 units in Denton, Texas, Village on University. Now, we did close on another property that I didn't have updated in here in February, and that is in Houston, Texas. It's called Los Prados Apartments, and that's 266 units. So as you can see, as the momentum gets built up, we're able to take down larger properties as we go. And the larger the property is, the cheaper it is for, or the more cost effective, that it is for our deal to be able to pay a property manager, full-time, leasing agent, full-time, on-site maintenance, security, things like that. Because we're able to, so for example, if you're on a smaller property, I've had this before, the property manager will want you to pay like 6 to 10% of the net rents on an apartment, or the net collections, of an apartment, to have them manage. Now, when we go to these larger properties, we're now going to like 3 to 3.5% of the net rents. So it's not like their percentage goes down, because for them, they're like, okay, well, we're still making, this certain salary per year plus bonuses and whatnot, but that, anyway, it becomes more effective because of economies of scale. And also, again, when it comes to larger properties and we're being able to order a massive amount of supplies at once, we get massive discounts. We're able to store things on property, and then be able to also utilize our contractors more efficiently, because they can do 5 units. I've got some guys doing 5 units now. They're doing 7 units at a time, and they're able to get like 2 floors worth of units done right at the same time. And then when they're done, they're done. Anyway, so long story short, great thing about multifamily and the larger multifamilies are economies of scale to be able to benefit from those. Let's see, I'll go to the next. There we go. Okay. And a lot of questions that I think investors may ask is, what do I get when I invest with my IRA, 401k? So I kind of want to answer that. So there's more benefits than just having mailbox money. I mean, that's great, right? But in addition, you get tax benefits. So you get, normally we always get depreciation when we have a property. We're able to take some tax advantages from depreciation of the physical asset itself. But because of the Tax Cuts and Jobs Act from our current president, we have bonus depreciation on top of that. So I just benefited from that this year in my taxes, to where, yes, you have depreciation, but you also have an additional amount of depreciation essentially. And depending on what you do for a career, or if you have a spouse that's also a real estate professional, you can also benefit from not having to deal with what's called passive loss limitations, meaning that, like, if you made 100K in active income and you'd normally pay taxes on that at a certain tax bracket, well, you have negative or depreciation of 100K, you're basically paying zero in taxes. Well, maybe you invested more than that or made more than that in your K1 income or passive income. So you made 200K in your passive income, you would still only be able to benefit from a 100K, because it's offsetting your active salary, amount of offsetting those taxes. So only 100K's worth. But if you had a spouse that was an active person in real estate, and what's the definition of that? That's a CPA question, not a Kaylee question, but you can also offset your spouse's income in addition too. So there's no limit, which is freaking awesome. And again, K1 passive income offsets earned income. You also get cash flow, so you have appreciation. So you have tax benefits plus cash flow. So those are mailbox checks, kind of self-explanatory. Investment is also secured by a physical piece of property. That thing ain't going nowhere. Like, you could invest in paper assets all day long, and as we just saw what happened to the stock market, guess what? My properties are still valued at the same amount. Nothing changed. So yes, whenever you have a massive change in like a depression, which we're not in a depression currently. We may be, but then possibly property values will change. But honestly, if you ask me, because again, we're researching future technology and things like that, I really do believe that what will be left at the end of the day I think the current currency is going to change. I think that, again, our monetary system's kind of broken, but so I think what'll be left at the end of the day, if we really look at it, is physical assets. So I mean, I'll trade your building for your building, I'll trade you a chicken for your chicken, things like that. I think, and then also being able to transact digitally money. So I think that that will come at a certain point in time. So I think not investing in paper assets in the long term is also going to be beneficial, not just comparing it to the stock market. You can also grow your retirement tax-free. Again, that's the awesome thing about being able to use your retirement accounts to invest in these properties. I'm so proud that we're able to be able to work with investment account holders. Same thing with other principals. We do really enjoy working with retirement account holders. Solo 401k. So if you have a business and you're a self-employed individual, you can look into this. Again, I am not a custodian. I don't know all the ins and outs of things, but I've had some investors tell me, hey, by the way, don't you know that you can, if you have a business and you don't have any employees, you can set up a 401k or solo 401k that actually will avoid UBIT tax. So whenever we sell the property, there's capital gains taxes, and there's also UBIT taxes. So if you're doing a 1031 exchange, you avoid the capital gains, but you're still subject to UBIT. So if you are a single employed person, a solo 401k is a great way to avoid those extra taxes. I don't like taxes. Keep your hands off my money is what I say. And then also what's really cool about these types of investments is it's kind of unbelievable where someone will invest. Like I own a couple of house notes, and I have a single family rental and some townhomes and other random things, just so I can compare the performances of those assets. And they're all different, But when I tell someone that's used to investing in something that they're like, okay, this is going to give me like an 8% return on my investment, or this is going to give me a 20% return on my investment when I'm doing, like new development, things like that. Well, to put this in perspective, the way that we do our value add deals, our target is to get our investors double-digit returns quarterly. So that's the mailbox money, aka cash on cash return. So that would start being paid out for us month 15. So that will just keep coming in the mail while we're holding the property, while it's appreciating, while we've already finished all of the renovations. Now, in addition to that, if it's a property that we purchased at, say, 100K, and then now after adding all the value, now it's valued at 200K, then we can cash out refinance. And when we do that, we would distribute that to all the members in the asset as well. So that's an additional payout. Plus, in addition to that, on sale, we're targeting, like I mentioned, about 100% return on investment. So, if you only got that check, if you put in 100K, you'd be looking at getting back 200K. That's just a super simple example, right? But in addition to that, you're also getting your quarterly plus the refi cash out if there is a refi that's appropriate. So, over 100% return on your investment, and so people don't understand that there's 2 to 3 different paydays, but overall, being able to stick it out for a little bit, like I said, worst case 3 to 5 years, it's definitely a huge return on your investment. So, minimum double digits, and then going up to triple digits. So people are like, what? I'm like, yep, I'm not kidding. Let's see. Okay, guys, that's all I got for today. I could talk forever about this and go into the weeds, but I won't. I'd rather hear from you and listen to your questions and answer those. But if you're interested in getting involved in multifamily investing and you have questions about anything I covered today, you've got my email and my phone number in front of you. If you're more of an Instagram person, you can hit us up at the apartment queen _, which is our Instagram profile. We're also on TikTok, working on that. But I know we've got all kinds of different types of investors. So if you guys have any questions, now is the time, and I'll be here for another couple of minutes.
Awesome. Thanks, Kaylee. I'm actually going to go over some of the self-directed IRA material really quickly. And then, as Kaylee said, we will have this recording available for everyone, and we will have slides sent out for anyone that would like to reference them. There were a couple of questions that came through. I'm going to try to just defer them to the end of the session. So I'm going to gloss over a couple things real quick, and I'm just going to move us to the next slide. Give me one moment, please. Okay, awesome. So I'm going to talk for maybe 10 minutes, probably not even that, just quickly about the self-directed IRA side of this conversation. So Kaylee did a really great job of explaining some of the advantages of using a retirement account for these types of multifamily investments. So if you're interested in doing that, you need to have a custodian to set up your self-directed retirement account, and then also help you with getting the funds moved over, reviewing your investment, and then processing your transaction. So that's basically what we do. We're not a bank or a brokerage house, but we're a financial institution that specializes just in these types of retirement accounts. So you'll definitely want to consider and evaluate a potential custodian if you're deciding to use a self-directed IRA or self-directed account for these types of investments. So quick disclaimer, we are a financial institution. We are not fiduciaries. So we do not provide any investment advice or endorse or recommend specific products, which is why, as Kaylee mentioned, it's important to be comfortable with doing your due diligence and selecting your own investments that you'd like to hold in these types of accounts. So the information that we're providing today is for educational purposes. And then, of course, if you do have specific questions, you can consult with other financial professionals as well, like an advisor, a tax advisor, or an attorney if it comes to that as well. So quick background, we are a women-owned business. We've been in business for 15 years, and we were founded by Jamie Raskolnick, who's still running the shop. She actually is a real estate investor herself, and that's sort of how she got into founding the company, because she owns a she owns a property management company, and she's also a certified broker. And she was looking to hold real estate in her retirement account, and she didn't know how to do that. So by researching, she found the self-directed IRA as a tool, and then she became very passionate about spreading this education to others. So that's how we got our start. So when it comes to self-directed IRAs, the major differentiators are really what you're allowed to invest in. So you're not tied to those typical public securities like stocks, bonds, and mutual funds that most people assume you're limited to. So now you have the ability to invest in non-publicly traded, what we call alternative assets with a retirement account. And Kaylee pretty much covered this, right? So you get those tax benefits. Depending on the account type, you're either going to have your taxes deferred or tax-free. And then you're going to have a little bit more control over that investment return, right? Because you're going to have some more say in what investments you're choosing. You're going to have some more insight into who's doing what. And you're going to have a little bit more control over the diversification of your retirement portfolio as well. And as we know, alternative assets tend to be non-correlated with the stock market. So they don't tend to, if the stock market takes a dip, you don't tend to see alternatives following that path. They tend to be more stable over time, so it's a good way to diversify beyond the stocks and bonds that you might already have. And why this is becoming even more important now is because we're seeing that retirement gap, the savings gap is widening, right? So Social Security is shrinking. There aren't a lot of pension plans or those types of traditional plans you used to see available for workers. So we are seeing for the first time in a while that 20% of individuals over the age of 65 are still working. And a large part of that is probably due to the fact that they just don't have enough money to retire. So really what's happening is the onus is being put on us as individuals to find ways to save more faster. And we're not getting that guarantee that we used to be getting from federal resources, unfortunately. So these are the types of plans that you can establish if you want to have a self-directed account. Your traditional and Roth IRAs, if you're self-employed, like if you're a sole proprietor, you could do a SEP IRA or simple. And then Kaylee mentioned solo 401ks if you have, or if you have an existing qualified plan for your business, like a profit sharing plan or other type of plan, you could potentially open that up to include these types of real estate investments. And then the last two are not technically retirement accounts, but they can also be used for alternative investing, and those would be to save for child's education expenses tax-free or related medical expenses as well. In terms of getting funds into an account, you can make a personal contribution just like you'd be able to do with any other type of retirement account. You can transfer funds from an existing IRA that you have with another institution to a self-directed account. If you have an old 401k that's just sort of sitting there not doing anything, you can roll that over into a self-directed IRA. And then if you have funds in like a tax-deferred account, you can move them into a Roth, which is called a conversion. And that'll basically what that's going to do is it's going to trigger a taxable event for that year when you do the movement. But from then on, all your investment earnings would grow tax-free in a Roth account. So you have all these options available to you. And of course, on a case-by-case basis, we can discuss them in more detail. The possible investments with self-directed retirement accounts include more than just real estate, but today we're talking specifically about real estate. As you can see, there are other things like, there's some overlap here, like limited partnerships could apply to a real estate investment, which is what we're talking about today, or they could be for other reasons. But private startup companies, hedge funds, any private stock, really, precious metals, and then even within the realm of real estate, we could probably do a whole webinar on just that. Private lending as well. So you can see there are a lot of things. The only restrictions are life insurance and collectibles. So what we're talking about today is when we talk about multifamily and the way that Kaylee's explained, the investment structure, we're talking about using a self-directed account to passively invest in, it's basically a private placement, right? So what happens logistically is you set up your self-directed IRA or account, you fund it through one of the methods that I just briefly went over, and then you work with your IRA custodian, like a Next Generation, for example, to review your investment before anything is done. And then basically what they would do is they would process the transaction so that your IRA is going to purchase shares or units of stock in an entity. So in this example, it's an LLC. You're investing as a limited partner. And then what happens is you receive those payments. As Kaylee said, the frequency is going to depend on the deal that you agree to, and that PPM, that private placement memorandum. But your IRA is then going to passively receive those payments back. And of course, those payments are going to be tax sheltered because they're going to go back into your retirement account, and then they're going to grow either tax deferred or tax free. So that's kind of what I just explained, just explaining that funds leave the retirement account to the investment, and then any payments generated or earnings generated from the investment flow back into the retirement account. So there are some prohibited transactions that the IRS has basically identified. When you're using an IRA, there are a few more rules that you have to follow. If you're doing a syndication, it's not really going to be an issue that you're going to come across these, but I just wanted to gloss over them real quick. So basically, a prohibited transaction with a retirement account is anything that involves your IRA and then a disqualified person on the other side of that. So disqualified persons would include you, yourself personally, and then any basically ascendants, descendants, or their spouses. So mostly family members, and then like any financial professionals that are servicing your account. So you're just not able to directly do investments with these individuals or have them benefiting from your IRA's investment. Really, the IRA should be the one benefiting from the investment that you're doing, because again, it is a retirement account and it is a long-term investment strategy. So just keep that in mind when you're looking at different deals. But just to be more specific, if you're doing syndication or multifamily type of investment, an example of a prohibited transaction would be if you were, as Kaylee said, if you were personally going to be an active partner or a director or managing member, then that would be problematic, right? So as she said, your IRA, in this case, it should really be investing as a minority limited partner and really hands-off passive investor. And then, of course, the earnings, as we said, they have to be paid directly back to the IRA and not you personally. If they're automatically paid back directly to you personally, then that would trigger a prohibited transaction, which comes with penalties, fees, and other financial consequences. And then going in hand with the whole, making sure that it's a passive investment. You're not allowed to personally do any sweat equity on that property, but I would assume that if you're getting into a deal like this, that you're not planning on doing any of that sweat equity, because that's sort of the idea of being a limited partner. And then, as Kaylee said, letting those professionals and those property management teams handle the day-to-day kind of work that needs to be done. I want to make sure I didn't skip anything. Okay. So just quickly, this is pretty much wrapping it up, but the process and timeline for doing this would be, again, opening a self-directed account, which with an application takes about 1 to 2 business days, and then getting the funds moved over from wherever else they're being held. It can really take anywhere from like a few days to a couple weeks, realistically. Sometimes we provide really conservative estimates just because if another institution needs to let go of your funds to make it happen, we don't have full control over how quickly they're going to move or what their processing times are. But we do work with you as the investor, basically guiding you through each step of the process to make sure that you understand what's needed and that we're following up to get the funds moved over. And then making the investment, again, is going to, and Kaylee covered this briefly too, is going to involve providing some paperwork to the IRA custodian to review. And that review is for compliance reasons. So we're looking for, is the IRA listed appropriately on the documents as the investor and not your personal name? Do we see anything that would constitute a prohibited transaction? Of course, if it did, we wouldn't process that, and we would let you know that corrections need to be made, because we want to protect the tax advantage status of the account you're using, right? Because that's the whole point of this. So once we complete that compliance review, we would process that transaction for you, and that takes a few days to get that done. So all in all, if you were looking from start to finish to set something up, I would say to be conservative and proactive, give yourself like 4 to 6 weeks to get everything set up and ready to go before we could pull the trigger on the actual transaction. And then these are the documents that we would need. So on the left side, for a private placement, which is what we're talking about today, there's some internal documents that you would need to fill out and sign to basically direct us to make the investment for you. And then on the right side, as Kaylee mentioned, the PPM there, we would need to see that, and you would need to review and approve it as the investor. And then anything else that applies. So if you're investing in an LLC, we would ask the investment sponsor for that operating agreement, and then any articles of formation. And then anything else that would need to be signed by normally the investor would be reviewed and signed by your custodian on behalf of your IRA. So really the benefit of doing this and using this strategy is, forming new relationships, joining the network of people that are doing this, investing in things that you already know. And then by utilizing the retirement account, you're just gaining those additional tax benefits. And as we said earlier, hedging against some of the volatility in the public markets and just diversifying beyond what most people are used to, thinking that they can do. So with that, I know I kind of breezed through it, but I don't want to go too much over time out of respect for everyone's time. But you can get in touch with us by checking out the website. There's a ton more information, and we'll also have this webinar recording eventually put up on the website as well, where we have a library of past webinars on different topics. If you're interested in opening an account for yourself and you want to speak to somebody one-on-one, you can email newaccounts@nextgenerationtrust.com, or you can call the office. We are working remotely. Since we're based in New Jersey during this time, things are a little crazy out here, as you can imagine, but everybody's still accessible remotely. And if you call the office, you may be forwarded to our cell phones. And of course, emailing is always a good way to go. And there's a live chat feature on the site if you prefer that as well. So with that, I'm going to take a look at questions we have for anyone who asked a question and wants an answer before the close of this webinar. Okay, let's see. There was one for Kaylee, if you're still out there, Kaylee. Okay. How long have you been, oh no, I'm sorry, I skipped over one. What's your best strategy for finding investors? That was for you.
Yeah, so I was just answering that earlier. So a lot of referrals is one of the best ways. So friends and family of individuals that have already worked with me, right? So they trust me. Also through my college network. So I went to Texas A&M University with a molecular and experimental degree in nutrition, and then other programs. But to those individuals that went to my school, we all have the same type of way we do things. We don't lie, cheat, steal, or tolerate those who do. There is a base bottom, trust level there too. So again, just groups that kind of already know me in some capacity. Another good way has been through self-directed account holders. That's really been a great avenue, because individuals, have money sitting in an account that's making little to no return, which is just a total waste of their retirement funds, and giving them an opportunity to be able to, double their money in most cases in a non-10-year period of time, or sometimes, longer. If you look at my dad's retirement accounts. So it's really been with those two groups who have been the biggest. And then now we're working on putting together, I don't want to be a mentor or a guru or anything like that. I don't, but putting together some interviews that I've had with, SEC attorneys, with, our underwriter. She just developed her own software, and being able to make those accessible to people who want to get registered in our system, to educate themselves and things like that, just on their own time. So that will be coming soon, and I could see there being a lot of people that would invest with us after they're done educating themselves, because that's like super important. But yeah, so far, referrals, networks who already know me, actually some doctors I forgot that I used to build their dental practices like 5-6 years ago, and then also self-directed holders, account holders.
Great. And then another question was, how long have you been doing this, and how many deals have you bought and sold?
Sure. So currently, this is my third year. And my first deal that I ever did was with my mentor, who is, I guess he's actually a friend. I hate saying the word mentor, but he taught me everything. So Will taught me first, then his active partner, Alex, taught me everything. And then he's still currently with us in 2 deals. But so right now, currently, we are in 1, 2, 3, 4, 5, 6 different apartments. Texas and Phoenix. And then currently we have turned over one. So it was 7 total. So now it's 6. And then we've got 1 or 2 that are side by side. We're gonna sell the portfolio. We should be done with those renovations by June. So I'd idealistically like to get that sold here within this year. So anyway, yeah, to answer your question, 1 and then 6 current, I think is the question.
Great. And then the other 2 questions I think were for me during the time I was speaking. I'm not sure that I understand exactly what this question is asking, but does it mean no distributions for the first year? So if you're looking to take a distribution from a self-directed account and you have an investment that you're already in, the only way that you can take a distribution, right, is by taking cash out of an account. For the most part, you can technically distribute ownership of something to yourself out of your IRA, but I won't get into that on here because it's a little complicated, and it wouldn't really apply to doing something like this. But basically, if you wanted to take a distribution, it would need to be in a cash position. So it's either going to be you're liquidating the investment you have in your self-directed IRA, or you are if you're receiving cash payments, like dividend payments from an investment that you're in, then you have cash in your IRA. So you could take those distributions technically just like with any other IRA. You could take them whenever you want. It's going to depend, of course, on your age and your circumstances as to whether you're going to be subject to a penalty, an early penalty of 10%. If you're over the age of 59 and a half, typically that wouldn't be the case. If you have a tax deferred account, your withdrawals would be taxed at the time that you take that distribution. If you have a Roth account, your withdrawals would be tax free as long as you're taking a qualified Roth distribution and it meets the criteria for you to be able to take it out at that time. So it starts getting into a little bit of a tax discussion, and there is more detail we could go to on that, but for the sake of today, we'll basically leave it at that. And of course, if you wanted to talk to a tax professional, you could do that as well. Do you hold the accounts at Next Generation? Yes, we do hold the accounts as the custodian. If you're an advisor, do you discuss with your clients on a consistent basis for reviews? So basically, if you're an advisor and you were able to advise them on these types of investments, if you're independent fee-based, you could certainly have access to your client's self-directed account by having them set up online access, and then we would give you interested party access into their account to be able to log in and review with them, what's going on with the account. So again, that's something we can discuss offline in more detail, but you would still have the ability, as long as your firm allows you to, you would still have the ability to be involved and help them and even earn fees on that, those advisory services from your end as well. Okay, I think we are good.
Last thing I want to put in there, one thing that becomes a large frustration of my investors whenever we've done these deals in the past, also, for us as a management team, that individual that asked earlier about, how many partners or limited partners would you take? And I answered by, unlimited, with the caveat that those unlimited individuals have already taken the initiative to make their account move from a non-self-directed to a self-directed, meaning like do that today. Because it takes, I'm usually running into like 4 weeks worth of mailing the check, to and from. There's resistance from the other custodian getting it over, then it going to your personal address, then you having to rush the check over to the actual custodian's office. It's just this ridiculous process. And now that we have COVID stuff, things are even weirder. So, I would really say like the biggest thing to help to not being frustrated as a investor and for us as a management team is having those accounts set up and already funded, so that when a good deal does come along, then the easy decisions of just having a conversation about questions you have and that kind of stuff can be handled. But it's not, because also my investors will feel rushed and pressured, and that's not fair, to make them feel like, oh, you got to do this now, because you don't have to do anything you don't want to. But if your account's already set up, it's just a lot easier for both parties. So I will say that.
Agreed. Yeah. And there's a lot right now to the point of, the COVID situation. that we can do electronically. So like the application we do through DocuSign anyway. A lot of financial institutions are waiving the requirements for original signatures on their forms, and they're allowing digital signatures. So there's still a lot that you can do efficiently, as long as you're, tech friendly and you're comfortable with that. And most of the documents for the transaction could be signed electronically. But yeah, definitely consider potential, delays in certain things getting turned around just because of the situation we're in. And it can't hurt to open the account. And then if you think you're going to have an investment within the next month, that's perfectly fine. You don't have to open the account and invest it right away. It's just making sure that you understand the steps necessary to get it set up. And then also, out of respect for yourself, not putting yourself in a situation where you're like up against a hard deadline and like you're rushing and you're stressed out and you don't want to miss the opportunity to make an investment. So definitely think ahead if this is a strategy you're interested in, and then of course we can, work on it step by step. So with that, I'm going to, unless Kayla, you have any closing comments, I'll end the webinar, and we'll basically have a follow-up email within the next day coming out with a recording. And then any lingering questions that were posed in the webinar, we'll make sure that we follow up with those individuals, because I know that there were a ton of questions that we got and we just don't have time for everything. But we will have those accounted for. So if you guys need us, you know how to find us, and you'll get that email within the next day or so. We appreciate everyone's time. Kaylee, anything else you'd like to add?
Not really. I just want to have y'all at least start paying attention to, if you're not already, the trends that are happening. I'm very fortunate, and I think that what's happened in my life up until this point, and where I've come from and moved from, and I live here alone, and just the trajectory of my life or whatever, I think I've been placed here for a reason. It's really interesting to watch, though there are national trends even throughout the 08, 09 recession with mortgages. Even if you look at the 30-year historical trends of how things have performed here in the Southeast and South, especially in Texas, and I hate to tout my own area, but I started looking at investments in surrounding states, flying there, checking them out, going constantly. And then I realized, you know what, I'm sitting in a great sandbox. And I really did a lot of research and realized kind of, I think historically how, it's performed, or apartment deals have performed here versus other places. So, if a lot of people really like, safety and reliance and something that would have the most probability of being successful, I encourage y'all to check out deals in the South and Southeast, Southwest, I guess down here in this area. So anyway, just pay attention to those. Or if you don't know anything, start doing your research.
Sounds good. All right. Well, thanks again, Kaylee, for being on. We really appreciate your expertise. That was great information. And thanks everybody that hung on a little bit longer than our allotted time. We wanted to make sure we answered as many questions as we could, but we hope you all stay safe and have a wonderful day, and we will be in touch soon. Thanks again.
Thank you, everybody.